Hello, and thank you for joining me today for the training video Forma 101, Understanding the Homeownership Development Sources and Uses for Projects in Due Diligence. I'm Jessica McKinnon. I use she, her pronouns, and I'm the Senior Homeownership Development Program Analyst at OHCS. Among other roles, I manage the Notice of Funding Availability process, or NOFA, for our homeownership development funding. In this video, I'll be going over the pro forma portion of the application and a number of related requirements. This training is intended for LIFT homeownership applicants who have been invited to complete due diligence for the 2026 and 2027 homeownership development NOFA. This training assumes that there will be a variety of experience among those watching this video. I recognize that some watching this video will be much more experienced than I am at building proformas, but that there also may be some attendees who have never completed a proforma before. So I'll start with some more general information about the components of a proforma and some of our requirements. I'll follow that with a look at a sample completed proforma to demonstrate how the form itself should be filled in, and then I'll cover a few special scenarios that you may encounter with your project that are a little bit more difficult to fit into our proforma format. So to begin, I wanted to make sure that we have a shared understanding of what I'm calling the proforma. At its most basic level, a proforma is a tool that you use to estimate the financial feasibility and profitability of your development project. The main parts of the proforma will be your financing and funding sources, your income, which is your sales proceeds, and your project uses, which is going to be all your expenses to build and sell the homes. OHCS also uses your proforma to assess the risk and viability of your project. So we will ask you to fill out your proforma in our template, and we will require your proforma to balance, or some people say pencil. This means that your sources and income are equal to or greater than your uses. So we'll want to see everything works out so that you earn at least a little bit of profit. You'll need to submit a first draft of your proforma during due diligence stage 1, and then we'll need a final version with all of your sources committed during stage 3. The first thing that you'll see in your proforma template is going to be your funding sources. In the most basic terms, this is where the money will come from to build your project, like your loans and your grants and your cash. And we'll ask for a breakdown and details on each one. Your form will automatically include your requested lift amount and your anticipated sales proceeds, but even if these two sources are enough to cover all costs, we do require that you have a third funding source available. This can be your construction loan, or it can be cash that you already have in your bank account. But the important part is that you have something that can cover the costs that Lyft can't before you start to sell your homes. When you submit your application at stage 1 of due diligence, you can include sources that you don't have a commitment for yet, but you consider highly likely. But by stage 3, you will need to have those sources committed or at least contingent on the receipt of Lyft. Getting a little technical here, you will need to distinguish in your proforma between funding that is given to the project and staying with the project, like a grant or lift, and funding that will need to be paid back upon sale, like a construction loan. Also, just a quick note here, your proforma should not include loans that will be paid back by Lyft or your construction loan at closing of the loans. This could be things like a land acquisition program loan or our pre-development loan. If you include both sources, it'll double count and show that you have more money than you actually do. We do need to be a little restrictive on what kinds of funding sources you can include in the proforma, but we do allow for most common funding sources that you may use. Lift, grants, sales proceeds, and land donations can all be included. You can include land acquisition and pre-development loans if they will stay with the project and not be paid off until later. You can include construction loans as well as lines of credit that are not tied to the project itself. You can include your own equity or cash that you currently have in your bank account or have already spent on the project, but you will need to distinguish if you're planning on investing those dollars and having them stay with the project, or if you intend on having them be paid back after home sales. We don't typically allow for future dollars as a source on your pro forma, but we provide an exception for certain annual income. This includes proceeds from any stores that you run, like a Habitat Restore or a thrift store. We also allow mortgage proceeds for Habitat affiliates and other nonprofits that still manage their own mortgages. If you'd like to use these, you will need to provide a profit and loss statement to prove your estimation of income. There are a few common sources that we won't be able to accept on your pro forma. The first is future fundraising campaigns. If you've already had a fundraising campaign and have that money in the bank already, that's great. List that as cash on hand. But we can't accept a source that says that you'll go out and raise $250,000 from donors over the next 3 years, because there's no proof or truth that that will actually happen. SDC exemptions have also proved to be a little difficult for our pro formas. If you will have proof of the exemption and how much the exemption will be before the final pro forma is due, we can absolutely include that. But if you won't have confirmation of your exemption until you receive a build permit, for example, we won't be able to accept that. We recommend listing your own equity or cash to cover this, just to make the pro forma balance. You can end up using the SDC exemption and not using what you put in the pro forma. We just need to see that it balances in case those SDC exemptions don't come. We also can't accept more than a single loan that will require a first position lien on your property. Your construction lender or a permanent lender are fine. We can share first lien with them, but please do not bring a third source that wants that first position. The next section of the pro forma will calculate your sales proceeds based on the units in your development. We'll be looking for a breakdown of your units by bed, bath, and by affordability level. So we'll want one line item for your 3-bed, 2-bath homes, one for your 3-bed, 1-bath homes, one for your 2-bed, 1-bath homes, and one for your 1-bed, 1-bath homes. If you've indicated that you'll be setting aside a certain number of homes to serve households earning 60% AMI or less, then we'll want to see additional line items for those reflecting a lower sales price. We do recognize that many of our partners will adjust the sales price for each buyer based on what they can afford. We do not need you to include a line item for each individual home. Instead, please consider listing an anticipated average sales price for all of the homes of that type and build. Your sales price must be affordable to the AMI level listed in the form, regardless of down payment assistance. So please don't tell us that you've secured $20,000 of down payment assistance for each home, so you can charge $20,000 extra for each home. That down payment assistance should be used to either serve a lower AMI household or buy down the mortgage for your buyer, not to increase the sales price and increase your profits. When you list your sales price, please only consider the amount of new money that will come to you. If you offer something like a soft second mortgage to enshrine the difference in sales price from the value of the home, do not include the value of that, please. And also, please take note, whatever price you decide, we will ask you to explain how you came to that price and how you know that there's a market and buyers for these homes at that price point. We're asked fairly often how much a builder can sell their homes for, and the answer is that it's kind of up to you. We consider you to be the experts in your communities and markets and generally respect that you're estimating values well, though we will flag it and do a little bit more research if it looks to be beyond or substantially different from what we normally see. That said, I can give a few suggestions for estimating your sales price. I'll recommend using your favorite mortgage calculator available online. A good rule of thumb is to estimate that the household size of your buyer will be the number of bedrooms plus one, but you can also consider your local market and either your typical buyer or a community that you're trying to serve. You should use HUD's estimated income for your AMI limits, but you should not consider the income for the exact AMI required. If you build your sales price assuming 80% AMI, then you'll severely limit your market. Instead, consider pricing your home for households at 65% AMI to give yourself a larger market of buyers. Interest rates, of course, have been unpredictable over the last several years, so my recommendation is to be conservative in your estimated interest rate. It's better to assume a higher interest rate and be able to sell your homes to lower income demographic than it is to assume a lower interest rate and lose your entire market, or worse, have to lower your sales prices and hurt the financial viability of the project. Also, don't forget to include your ground lease fees or any HOA dues in the affordable payment calculation. The last part of the pro forma is your project uses, which is the breakdown of all your expenses and costs to get your project built. This part of the form is broken down into a few major sections, and this slide runs through the more self-explanatory sections. There's an acquisition cost section here where we'd like you to put the cost of your land. If you receive the land as a donation or steeply discounted cost, we would still like you to put the full value of the land here and then list the donation or discount as a source in the funding sources section. There are three main lines in the hard cost section. We'll ask you for the estimated total of all of your site work, so your streets, sidewalks, lighting, utility mains, and then we'll ask you for the total of your vertical construction costs, so your walls, roofs, foundations, and interiors. We'll also ask you to pull out the general contractor's general conditions, overhead, and profit. We won't ask you to break down the expenses for us in our pro forma format, but we do ask that whatever evidence of costs you provide us be itemized, at least for the vertical construction costs. There is one section for pre-development and soft costs where we sort of jumble all of your other expenses together, from site feasibility studies to marketing costs and interest. And then we'll have a section for you to budget for contingencies and escalating costs. There's also a section for OHCS charges. This section is mostly completed for you, and the slide breaks down what you can expect to see. Your application charge will be included, so either $2,500 or $1,250, depending on your project. You'll have already paid this by the time you're completing your pro forma. It will automatically calculate your recipient charge, which will either be $1,000 or $2,000, depending on your project. This charge will be due during stage 2 of due diligence after you pass stage 1 and have already submitted the first draft of your pro forma. Your lift reservation charge will be automatically calculated at 2% of the loan amount, which will be due at closing of the lift loan. There's a document preparation charge of $750 per recorded document. We typically see 2 or 3 documents, so we've filled that amount in for you, but you will be able to edit this section in case your project is going to be different. And then lastly, we do pass through any of our DOJ fees to you. If this is a typical deal with no negotiations, you can expect to pay around $1,200. If you ask for a lot of changes to our documents or require negotiation, which is not something we recommend, please expect that charge to increase substantially. There is a note here about the OEHTC usage fee. If you were using OEHTC, this is paid by the lender, not you, so it doesn't need to go in the pro forma at all. Also, please don't forget that all of these charges will need to be paid by that third source. The bonds that fund Lyft specifically disallow using them to pay for our agency's charges, so we will need your construction loan, cash on hand, grant, or similar source to cover those costs. As you probably know already, we updated the way we calculate your developer fee, which means we also updated our pro forma to match that new calculation. So you'll find a section that does that calculation for you. The new developer fee is calculated as any profit that you take as an organization, plus if you have a third-party developer, any developer fee that they take, plus the full cost of any contractors, consultants, or services that would typically be done by a developer. So if it's just you and you're doing everything, then you'll be able to claim up to a 14% profit as the developer fee. But say you actually would like to hire a project manager, and the cost for them to manage this project will be 2% of the total project costs. That means that you will need to reduce your maximum profit to 12%. Now, say your project manager actually advises that you really need to hire a developer because you don't have the capacity or experience to manage the project. That developer wants a 10% developer fee. Then that means that you will have to reduce your own profit to a maximum of 2%. Just a few more requirements. Of course, that maximum developer fee is 14%, but that fee is totally separate from your general contractor's profit. Most general contractors will charge some combination of their profit, overhead, and general conditions. Whatever that combination is will need to be less than 14% of the hard costs of the project. If there's an identity of interest, like if you serve as your own general contractor or your contractor is a board member, then the maximum profit will be 10% of the hard costs of the project. We have both minimums and maximums for contingencies and escalation. So both contingencies will need to be between 2.5 and 5% of their associated hard costs and soft costs. And then your escalation budget will need to be between 5 and 10% of your hard costs. Then, of course, your pro forma will need to balance with no gaps. The last thing I wanted to cover before diving into the sample pro forma is a discussion on cash flow. Everything we've talked about in this training focused on total amounts, but our pro forma also requires you to project when the funds and costs will occur over the 3-year development timeline. This is so important to make sure that your funding will actually be available when your costs will come up. As just an example, it would be a huge problem if your third required source of funds is a grant that would come in the second year of your project when all of OHCS's charges will actually come in year 1. So we talked about funding sources, sales, and costs, and each of those will have their own cash flow breakdown for the 3 years. We will make sure that in each year you will have enough funding to cover expenses, and we'll also verify that you have enough of a third source available in the first year to cover the OHCS charges. So let's dive into a sample application and what it'll look like when you complete the form. The first part of your pro forma will appear on a tab called Sources and Financial Assumptions. The funding sources will be the first part of the table you'll see. The table is broken into 5 key parts. The first is just what the funding source is. This section is broken into committed sources and highly likely sources. During stage 1 of due diligence, it's okay to have both, but all sources will need to be committed at a later date. The next section is the cash flow. As we discussed in the previous slide, this is where you'll break down when you will plan to actually draw the funding from your various sources. In this section, you have to fill out the cash flow before the total amount populates. Next is information about your loan. The lift loan is already filled out for you, but we do ask that you complete this for any other loans you have, like your construction loan. If you don't have any other loans, then you can leave this all blank. These next 2 columns are very important and tell us if your funding source will need to be repaid when you sell the homes and how much that'll be. It helps us make sure that your project is balancing and that we're not overestimating the funding that can be used as profit. This is most common for construction loans, but there may be other sources you'll need that for as well. But then the last two columns are just a little bit of extra information about each source. So you'll need to look at these for all of your sources, not just the loans. So zooming in for a little more detail, here's the source of funds and cash flow section of the sources. So starting at the top, sales revenue will populate automatically using the sales section of the pro forma, which we'll dig into next. So you don't need to worry about that now. Our sample project here has a few more sources that have already been committed: a construction loan, our own cash on hand, which is proceeds from a fundraiser that's already been committed, and then the value of our land donation. In the cash flow section, you can see that I expected to draw funds from my construction loan across the development period, with more anticipated in the second year. And then the funding I've already raised and the land donation will all be available year one. You can really consider year one to be the first year and any time up until now. So even if that land donation happened 3 years ago, you can just put it in that year one column. In the highly likely section, the first line item is always going to be lift. The total amount will pre-populate from the project information tab of your workbook, but please don't forget to fill in the cash flow for lift. We'd like to know when you expect to draw your funds from us. And then this project is also hoping to get a foundation grant that'll provide $200,000 per year for the 3-year development period, but we haven't gotten confirmation on that yet, which is why it's in the highly likely section. Moving on to the rest of that sources table, we'll want to fill out the loan details for the construction loan. We'll say this one comes in at 6% interest for 36 months. And then again, very important, we'll need to indicate that we will pay back the construction loan with our sales proceeds by selecting yes in that column. The amount in the total repaid at occupancy column will automatically fill in with the full value of the loan. But you may notice that this column is a darker gray than the other gray areas, and that's because you can change it if you need to. So for example, if you get a loan that's $4 million, but $1 million is unforgivable upon completion of the project, then you can correct that amount to be $3 million. None of our other sources are loans, so we can skip the loan details section, and then none of those sources will need to be paid back at the sales of homes, so we can just select no and move on. The next part of the pro forma, also included in the Sources and Financial Assumptions tab, is an accounting of your home sales. This section has 4 parts. The first part is a description of your homes. If this is a scattered site project, you'll need to show which site each group of homes is on, then the bed bath count and number of stories. Remember that you'll need to do an accounting for each different home type. Next is the cash flow for the home sales. Only in this section, you're not estimating money, but how many homes of each type you're expecting to sell each year. Like the funding sources above, the total will calculate automatically from the cash flow. Next is a little bit more information about the units, and then the actual anticipated sales price. So let's talk about the first 2 items here. You'll notice that they're both 3-bed, 2-bath units. They also both have the same square footage and number of stories. These are actually the same units, but some of them will be sold at 80% AMI, and some of them will be sold at 60% AMI. So we've listed those as 2 separate line items with different estimated sales prices. We did the same with the 4-bedroom units in the next 2 lines, even when only one of those units will be sold below 60% AMI. The next part will be on a separate tab in the workbook, and that'll be your project uses. Each of those larger cost categories will be broken into sections. Like these acquisition costs and hard cost sections here. All of these sections will be included or will include plenty of space for you to add additional expenses that we may not have already included for you. You'll need to type in the total cost of each of those line items, and then you'll need to estimate when the costs will need to be paid across the 3-year development period. Please make sure you fill this out for every line item that includes a cost. So in this example, we have the $1 million for land acquisition, which is offset by the land donation in our sources. We've estimated site work will take place in years 1 and 2, and vertical construction in years 2 and 3. Then we have a third line here to call out the contractor's general conditions, overhead, and profit, which we expect will be paid in years 2 and 3 in this example. The next section is the pre-development and soft costs table, which is much longer. The costs are sorted alphabetically, so hopefully it'll be a little easier for you to find and include your own costs. Also, please note that all of these numbers are totally made up for illustrative purposes and do not represent what we actually expect a feasible project to look like. We just wanted to show you how each line item could be filled out and then broken down in the cash flow. I wanted to call out this line where we added an other cost. In this case, we incurred some imaginary tree mitigation fees that came out to $10,000. Like this example, please update the blue cell on the left to list what that other cost actually is. The next 3 sections are the OHCS charges, contingencies, and the developer fee calculations. The OHCS charges are already filled in for you, and they're all listed as being required during the first year of the project. A lot of the cells are locked, but we did leave the DOJ charges and doc prep charges unlocked for you to edit if you need to. If any of the other cells are wrong for your project, please let us know and we can fix it for you. The next section is contingencies. We've built in a formula that calculates the maximum contingency you can include, but you'll also need to meet a minimum. We show you if you meet that requirement a little later in the form. You will need to include a cash flow for your contingencies. Obviously, you don't know when contingencies will be required, but please do your best to guess when you might need to have access to them. The next section is the new calculation for the maximum developer fee. We've included line items for what we think we'll commonly see, like the developer fee for a third-party developer, a project manager, application consultant or grant writer, or a developer consultant. There may be some other examples here. In this example, we have included a project management fee of $100,000 each year of the project. I wanted to flag this note here. This section does not include your own profit. That'll be calculated at the end. If the only thing counting towards your developer fee will be your own profit, then you can leave all of this section blank. Once you've completed all your sources, uses, and sales, everything will be summarized for us at the end of the Project Uses tab. The first thing we'll look at is the summary of your cash flow. This will tell us if you have enough funding each year to pay for the expenses. Each column will calculate the total sources in that year, plus anything left over from the previous year, and then subtract the expenses that you've included for that year. If these all show up as green, then you meet our requirements. If any of them appear red, then that means that you haven't budgeted enough funding for that year. The next thing we'll look at is your profit and developer fee. To calculate this section, the Forma takes all of your sources, including your sales proceeds, subtracts all of the listed expenses, and all of your loan payments. And then anything that's left over is calculated as your profit. The developer fee percent adds together that calculated profit, and then anything that you listed in the expenses that count towards the developer fee, and then divides that by the total project cost. So in this example, we aren't personally earning a 7% profit, but combined, our profit and the project management fee we showed earlier add up to 7%. The next two sections are simple compliance checks. We'll check to see if your contingencies are above the minimum and below the maximum. And then we'll check to see that the number that you listed for the contractor overhead, profit, and general conditions is below our allowable cap. If any of these cells are red, then you are not meeting one of our requirements or something isn't filled in. I might flag your contractor percentages section here. If that is showing up as red, but your percentage is less than the 10 or 14% requirement, go back and check your developer tab. There is a section there that asks if there's an identity of interest between you and the general contractor. If that is not filled in, this will show up as red. Now, before we finish, I wanted to bring up just a few special scenarios we've seen that aren't as easy to fit into our pro forma document. The first I wanted to mention is your cash on hand. Sometimes when you spend your own money on a project, it's going to be treated like a donation to the project. You raise donations and spend it, or you've saved up knowing that you'll use these dollars to reduce the sales price of your homes. But sometimes you might want to consider the cash you spend on a project to be an investment that you'd like to get back. Maybe you paid for the land purchase out of pocket and want to recoup some of those funds, or you have a revolving fund that helps you do your project feasibility that you'd like to get that funding back so that you can start the next project. And that repayment should not count towards your maximum profit percentage. So you can do either of those or a combination of both in our pro forma. The way you can do this is to list a cash on hand source in the funding sources section. If you will consider your cash to be a donation to the project and you don't expect to get it back, you can just select no, like we did in this example here on the slide. But if you want to get some or all of it back, then you can actually select yes here and then adjust the amount in the total repaid at occupancy section, so that dark gray column, to show the amount that you actually want to earn back from the cash that you put into the project. The next special scenario is if you want to share your contingency and profit. We have some partners who generally consider their profit to be the contingency rather than budgeting it separately. If they're not able to stay in budget, then they get a smaller profit. In the past, we've had to do some strange things like list that as a deferred developer fee, which made profit calculations more complicated, but we've updated our pro forma now. There is a small contingencies section on the sources and uses tab that will ask if you'd like to leverage your profits to cover your contingencies. If you select yes, then the summary of the developer fee calculation will update with an additional line showing what your developer fee will be if the contingency isn't spent. In our example project, if we answer yes to the contingency question, you can see that if we don't end up spending our contingency, we could earn up to a 13% profit. Either way, this shows that both scenarios are still in line with our requirements, so sharing the resource will work out for this project. Our last special case scenario is if you're repaying a loan with another loan. We've run into this a couple of times where a developer has a 1-year loan for the first year that has a better interest rate but needs to be paid back quickly. They'll use the first loan and then they'll pay that back with the construction loan when it comes due the second year. If you have something like that, you will want to include both loans on the pro forma. So the steps are on the slide. List the first year loan and include the full amount. List that it will not be repaid with sales proceeds. Next, list the second loan that will be paying off the first. In the cash flow section, you should list only the amount of new money that'll be available to the project. The funding that will go into paying off the first loan. You'll list the loan as being repaid with sales proceeds, and then you'll include the full amount in the amount repaid at occupancy. So in the example on this slide, we had a first year loan of $500,000. In the second year, we got a $1.5 million construction loan, and we'll use $500,000 of that to pay off the first loan. We listed the full $500,000 for the first loan, but in the cash flow, we only listed $1 million for the construction loan rather than the full amount. On the right side, you can see that we did not list the $500,000 loan as being repaid, but we did correct that construction loan and note that we would be repaying the full $1.5 million. And then that's everything that I have for you today. Hopefully this training was able to answer any questions you had and will be helpful as you get started on your own Performa. If you do have any other questions or run into any issues, please don't hesitate to reach out to us. You can reach out to your development officer, to me directly if it's about your Performa, or just email our general inbox, which is listed here on the slide. That's ho.development@hcs.oregon.gov. Thank you so much for your time and interest in our program, and have a great rest of your day.